Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Surbhi Upadhyay, and it's a strong start to the week. And I think it's countdown 25,000 on the Nifty, right? We were 65 points away. 24,935, and it's good to see follow-on buying because Friday we had that big monster rally. The Nifty moved up more than 400 points, and today we've added on another 100 points. Mid-caps are outperforming, and banks have come back into the action. Look at the banking Nifty, 850 points up.
And I guess that would be the most heartening part for a lot of people. And this is despite the fact that it's not like we've had blowout numbers. Of course, ICICI Bank's numbers were again solid. Again, a very strong showing from the bank without too many issues to speak of. But you've got others which have shown marginal hiccup in asset quality, for instance, or a little bit of a miss on profits. But despite that, you've got the banks bouncing back. And, that's extremely good news for the market. And not just banks, you have a couple of very strong pillars that are working for the bulls today. So there's banks, there are stocks like L&T, there's Reliance that's lending support. And then you have some of the plays on the PSU side that are still working really well. I mean, look at stocks like BPCL, ONGC. These are still up and about. So largely speaking, the market seems to have plenty of legs. Of course, some of the high flyers from the pharma space from last week, they're cooling off. Remember Cipla, massive surge after what was a great quarter. So that's a stock that's cooling off a bit. But otherwise, it's bulls continuing to charge ahead.
Okay, in fact, let's get to the big story from last week, right? Mankind Pharma is all set to acquire 100% stake in Bharat Serums and Vaccines, BSV as we call it, from Advent International. And it's a big deal. The enterprise value is 13,600 crore rupees. This, remember, was a CNBC TV18 news break. With this acquisition, Mankind Pharma will now enter women's health and fertility drug market. To discuss this and more, we have with us Rajiv Juneja, MD and Vice Chairman, and we also have our in-house expert, Ekta.
Thanks very much for joining. Thanks very much for that, Reema. Well, Mr. Juneja, thank you very much for taking the time out and speaking with us, and congratulations on this acquisition. We did quiz you about this extensively just a couple of weeks ago. But nonetheless, just wanted to start by asking you about the funding of this deal. It's around 13,000 crores plus in terms of enterprise value. How will the deal be funded from Mankind's end? What is the mix of equity, internal accruals and debt?
4,000 crore rupees would be coming from internal accruals by the end of the year when this deal will be finalized. And the rest would be a mix of debt and equity both. Majority would be debt and minority would be equity. I cannot just tell you how much that would be, but yes, that would be mixed back. It's a fantastic kind of a entity which we have acquired. We are very proud of it, and thank you so much for your wishes. We hope that we come up to everybody's expectations. We are very confident for that.
Okay. So just wanted to, understand this a bit further. So you have around 4,000 crores in terms of internal accruals right now or cash on books. All of that will be deployed towards this acquisition.
So why not? I mean, for any enterprise like us, debt, we would always like to have less. Equity is very close to us. So we are supposed to be making a balance of it, squeeze out everything and give some kind of a pressure on ourselves only to perform even better. That's a way forward to make our dream kind of a company become successful.
Okay, so what would the debt component be up to? Because you just some time ago, you raised your borrowing limits to 12,500 odd crores. You mentioned that you'll probably not even, you look at equity to be the minimum in terms of this, funding of the deal. So what can be expected to go up to? Around 8,000 crores in terms of debt? Would that be a fair assumption that you'll probably take on your books, 8,000 to 9,000?
I try to understand that both Mankind and Bharat Serum both are cash generating entities. We generate quite a lot of money, every year. So whatever that cash would be there, we'll just deploy that for internal accrual. It can be 4,000, it can be a bit approximately plus minus. Apart from this, debt versus equity ratio will not be crossing 2 times. We have decided internally. So that would be like that only, just to keep it play safe, conservative. And I hope that in next 2 and 3 years' time, we'll be able to just become neutral to any debt.
Okay. equities, 7,500 crores was what you had taken in terms of a board approval. You're saying that it's going to be as little as possible because you don't want to dilute stake. So around 1,000 to 2,000 crores. Give us a figure or a range upwards that you would probably be working with, which would be a maximum comfort limit for Mankind.
Comfort limit would be, minimum only. In the sense, it can be anything, 20%, 25%, 30%, not more than that, from the rest of the amount after giving this 4,000 crore rupees. So it will be, in the back, this would be a mixed bag. Majority debt, minority equity, will see at that time only.
Okay, all right. I think we'll quiz you about the mix closer to when you would, maybe probably a couple of weeks down. But the acquisition itself, we understand that, this acquisition has high entry barriers. It is in the women's health space, critical care, and that is going to bring a lot on the table. But there was some concern about the valuations. It's around 8 times EV to EBITDA, 8 times FY24 trailing sales, 28 times EV to EBITDA on a trailing FY24 basis. Can you give us a sense in terms of the justification or the rationale behind the valuations when it comes to this acquisition?
First of all, try to understand the philosophy of Mankind. Our strategies have always been very, very clear. We have articulated our strategies a number of times. The first basically is the bottom-up approach. That was the starting, actually. And in this process, we were covering 4 lakh doctors. It was our way of creating some kind of entry barrier. And next was our OTC flavor, OTC products, just to make Mankind brand as a quite a substantial brand. And third was creating some kind of a chronic business that we were quite successful. The fourth was creating a specialized division that we did 5 years back from Mumbai. And the last was super specialty business. So this strategy from day one was absolutely clear. Now coming back to your question, by the end of this year, this would be closing, right? If you see on the in 26, year 26, our EV EBITDA would be in the range of 17 to 18x. So we don't see, it's a expensive buying, it's a good buying because it has really added a lot of value, weightage to Mankind. It's not a branded, generic kind of a thing. It's a company which has come with high entry barrier products, complex products, difficult to make products. Plus many other things are there. Like, for example, many products are there which will be unlocking. It has a flavor of OTC. Lactare is one brand. Osopan once upon a time was a very big calcium brand, which is not. So a lot of things are there. It's a combination of things. So when you want to buy a value asset, you end up paying the right price. It's not expensive price, in our own opinion. Plus, Mankind has always played a longer game. We never have ever thought anything in short term.
Okay. On the margins, BSV reported margins of 23%. I'm not talking about the adjusted at 28%. You closed FY24 with 25% margins. What are the blended margins based on the synergies that we can expect in the next 2 to 3 years? Where would the margins on a blended basis fall once the integration is complete?
If you just deduct one-offs, any which way you look at Bharat Serum, their top line growth is more than Mankind. Their EBITDA margins are more than Mankind. In 21 to 24, their growth in EBITDA is 21%. Their EBITDA margin last year, if you just leave one off, would be approximately in the range of 27%. So any which way you look, it's attractive buying for us in terms of financial terms, in terms of having the kind of products, kind of R&D power they have got, which Mankind never had.
Okay. All right. Mr. Juneja, just a larger story about Mankind. You do have a consumer business which is quite popular in terms of its brands, but now you're looking very significantly and very closely at the chronic care segment in India. Give us a sense in terms of where Mankind would be. You crossed 10,000 crores in terms of revenue in the previous year. What is the larger picture for Mankind? Is it going to be a domestic-focused company? Are you probably also going to look at entering the export market? Is the consumer business now going to become a very small aspect of the larger picture of Mankind, which is probably going to be a pure-play pharmaceutical company now? What's the larger vision?
The larger vision has always been very, very clear that we want to institutionalize, first of all, Mankind. That's one thing. And apart from this, we'll always be domestic-focused company, and time and again, we have narrated, whenever the question of export would be there, we will be interested to export something which is difficult to make, complex, with high entry barriers. And if you look at Bharat Serum's number of products, in number of cases, their products have no competition. One product I will specifically mention, that is anti-D, zero competition till 2028. They have a patent. Their antibiotics are nobody else really makes it. In one of the fastest growing market, which is infertility, they have 2 or 3 competitors. We should see Mankind going to those places where entry barriers are very high. And what's the meaning of that? Instead of having 10 competitors, 2, 3 competitors, or in some cases, no competition. Now comes the question of consumer side. In consumer side, we have hived off our consumer division because we're very confident that this will grow a lot. Who knows tomorrow that one of the products we have acquired from Bharat Serum, Lactair or Osopan, can be given to our consumer division. Time will tell us. But because these products have a consumer division kind of OTC, OTX kind of flavor. Why we have hived off consumer division? Because we want to bring right talent. We want to make it a very responsible company. Board should be different. So once you create that kind of a company where tough questions are being asked, we are challenging ourselves. We want to just make sure that right things are happening. And we are doing quite good in that as well. We launched the Praga News is doing fantastic. Manforce is good. And recently we have come in a one product, Over News. I mean, because 78% would-be mothers don't know which are their most fertile days. We have some kind of a fascination for women products. Again, look at this Bharat Serum. How many products have come for the women's side? So not only now Mankind would become number 1 in terms of gynec side, women healthcare side. We have some kind of, I'll say by default, it's happening.
Okay, all right, Mr. Juneja. We'll touch base with you closer towards the closure of the deal as well to get more clarity in terms of how exactly it's going to be funded and more questions there. Thank you very much for joining in and speaking with CNBC TV18.
Victor, thanks a lot.
Okay, Eka, thank you very much for taking this conversation forward. We need to slip into a very short break. We'll come back and discuss commodities with Manisha Gupta. Stay tuned.
Welcome back. Let's now talk about the commodities market. We have Manisha joining in. She's looking at silver this morning. Manisha, tell us what's the latest.
Well, we have seen prices decline for the last 2 or 3 weeks when it comes to the precious metal prices, and silver's decline has been sharper. If you look at the last 5 or 6 trading sessions, we've seen silver prices decline by 3%, and for the month of July, we're down by nearly 5% now. For 3 consecutive weeks, it has been a declining trend continuing for this one, as it has been the case with the other industrial metals as well, which have been declining. Well, weak industrial data and, more importantly, unwinding of the long positions by funds and money managers has been weighing onto the space as well. In the international markets, we've come off from $32 an ounce to below $28. For the Indian markets, we did see an all-time high of 95,700 rupees a kg, which has seen a decline to almost 82,000 right now. In the previous week, we did see prices decline 81, below 81 as well, with most charters telling you that this is slightly bearish as a trend that we've seen in silver, and a breach of 80,000 on the lower side also is a possibility. Well, India's import duty cut by 9% also has been weighing even more for the Indian markets right now. For this week, though, it is going to be important to watch out for the dollar on how that moves. You have Australia inflation numbers coming in, and then Bank of Japan monetary policy meeting where there is an expectation of an interest rate movement. These are some of the major cues that the street will watch out for.
Thank you very much for that. We will slip into a very short break on that note. On the other side, we'll also invite the management of TCI.
We actually have
Vineet Agarwal with us on the show. Go ahead.
Okay. So, well, looking at numbers that TCI posted, we have Vineet Agarwal with us on the line. Let's just quickly run through the numbers before we get the conversation started. So, for the first quarter gone by, the revenue growth that TCI has put forth is around 10%. EBITDA is up by about 3%. The profit growth is around 11%. Small dip in margins, just about a 50 basis points dip. Margins have come in at 9.9%. This is, of course, a year-on-year comparison that we're doing right now. Mr. Agarwal, great to have you with us. Can you just start by outlining what the trends are like and, just take us through all the three segments? First quarter is done. We're practically, getting over the second quarter as well. Where do you see sluggishness and where do you think is the bulk of the growth going to come from this year?
Hi, always good to be here. Usually the first quarter is the weakest quarter because, typically after you're coming off from the March quarter, which is really, really good, things tend to slow down a little bit. We have, for example, in the automotive sector, there's a lot of stock that is still there, and that stock is not moving as fast as it should have. So there is a collection of that material that is happening. Simultaneously, in other sectors, so if I go division by division, freight business did reasonably well. However, the LTL business has not picked up as we expected because MSMEs are still not there yet. I think with the elections in the first quarter, things were a bit slow. There was a little bit of less buying, and also orders were not flowing through completely, as in money was not being transferred as much and flowing through the system. On the supply chain side, generally things were good. We've acquired a lot of new contracts, especially in the automotive sector as well as in the warehousing business. So both of them are looking very attractive. In the automotive sector, even though there are some companies that are stagnant in terms of sales, there are new companies that are coming up. For example, in the EV space, and there we are doing a lot of transportation for them, using both road as well as rail. The seaways business did reasonably well, much more than expected. We had 2 ships that were in dry dock in the first quarter. Even then, freight rates have firmed up. Actually, what has happened is that with the Red Sea crisis and international freight rates moving up, some of those ships have actually moved out of the domestic sector into the international sector, which means that the domestic freight rates have firmed up. Simultaneously, bunker prices, that is the oil prices, have also firmed up. So that led to an increase in rates. We were able to keep up the voyages as we had in the previous year as well. So that has helped that business. Net, it has been a much better quarter than expected, and the guidance continues for 10 to 15 on the top line and 10 to 15% on the bottom line.
10 to 15% on the bottom line. I think in the last conversation you had spoken about 10 to 11%. So is there scope to push up margins all the way to 15%, or you're just giving a wide range?
Well, there are lots of uncertainties that always are in the marketplace, especially with the crises that are happening overseas. So that tends to affect the margins a little bit up and down. We are looking at positive territory, so I would be confident to say that 15% is more likely.
Okay, and even on the top line, do you think you will be able to push closer to 15%? Because last year you managed only a 7% growth, and Q1 has been 9%, so still not in double digits.
Yes, I think if you see the general trends that are there, typically in now onwards, we'll see festival season, really the stocking that starts happening now, whether it is the consumer sector, whether it's automotive, those will start playing out. Then we see the budget has been good in terms of the flow towards infrastructure spend will continue. So that trickle-down effect, which is a 3.5 times effect of any infrastructure spend, that should help as well, capital goods sector and the related sectors. Apart from that, there is hopefully by maybe with the monsoon season being good, we should see again a better pickup overall. So capacity expansion and private capex should also start coming in. So that means that we should definitely start looking at a higher growth rate for the quarter. We are directly linked to GDP growth as a logistics sector. So we feel that there will be definitely some pickup in the second half of the year.
Okay, so sounding fairly confident of maybe 15% growth rates at the top line and the bottom line level. Got that. Speaking of capex, what about your own plans? I think the earlier figure that you've shared is about 275 crores. Does that stand, and what's the progress?
Yes, the capex is about 375 crores for this fiscal. This included the acquisition of two ships, that's the order of two ships that we have just placed as of last week. These are two ships that will be ordered in China, and they will be delivered sometime in the year 2026. So some advance payment for that will happen as well. Simultaneously, we are also investing into trucks as well as warehousing space and, of course, containers and the like. So the 375 crores stands. I think we'll be around 350 to 375 crores this year.
So, Vineet, just a question. Since you're adding more capacity on the seaway side, you're getting these ships in. Say by the end of the year, what's the revenue mix that you would hope for? And, I think more realistically, let's talk FY26, because that's the highest margin business, right? That's where margins go as high as 27, 28%.
So, this year's revenues for the seaways businesses will be almost the same as last year, or maybe slightly better. But we don't expect the capacity to come in, as I said, till 2026. So then definitely there is this is about a 20% expansion in capacity. But notwithstanding, we are also looking out for a second-hand ship. Since the markets are very hot right now globally for shipping vessels, we are still waiting to see for it to cool down a bit and then acquire another vessel in the next few months, hopefully. So if that happens, then capacity expansion by 2026 should be in excess of 30-40%. But also some ships will go out of service because they will get to the end of life. So 25% capacity expansion would definitely mean a 25 to 30% jump up in revenues by 2026 for this division.
Thank you, Vineet, for joining in. Now we'll get into that break. But on the other side, we'll discuss the big deal. Why is Ultratech Cement buzzing in trade? How are they planning to fund this big acquisition? That's the big news maker today. And we'll also talk about the upcoming IPO of Ola Electric. Welcome back. The big story is that Ola Electric is finally going to be making its debut on the exchanges. Today, the price band is out, but the IPO opens on Friday, 2nd of August, and will close on the 6th. Remember, this is India's first pure-play EV two-wheeler, which will be getting listed on the stock exchanges. Sonia, take us through the key details, the financials.
So, this is the much-awaited IPO of 2024, and details are finally out. As you said, it's not only India's first pure-play EV two-wheeler maker, but it is also India's largest electric vehicle two-wheeler manufacturer that will be hitting Dalal Street in a couple of days from now. The IPO opens on the 2nd of August. It closes on the 6th of August. And this is, the Indian electric two-wheeler industry is expected to grow at a compounded growth rate of 11% to reach a size of $35 to $45 billion by FY28. That is what Ola has projected in their RHP. And hence, there's a lot of scope for this business to grow. Now, let's not forget that Ola Electric, although the revenues are growing very well, it is a loss-making company. For the last 3 years, the financials of which the company has shared in the RHP, Ola has posted losses, and the losses have only, mounted. So as of FY24, they reported a loss of 1,584 crores. This compares to a loss of 1,472 crores. But let me take you through the details of the issue itself. The price band has been set at 72 to 76 rupees per share. The total IPO offering is 6,146 crores, out of which it is a fresh issue of 5,500 crores and an OFS of an offer for sale of 646 crores. Now, in this, the promoter Bhavish Agarwal Agarwal is amongst the others which are selling their stake. There are also investors like SoftBank, Temasek, Matrix Partners that are selling in this IPO as well. Now the company intends to utilize 1,600 crores of the net proceeds for investments in R&D as well as in capex. If you look at the financials, as I said, the revenue growth has been quite good. So the total income was about 5,240 crores in FY24. This compares to 2,780 crores in FY23 and just 456 crores in FY22. So it's been a big jump in revenues, while the losses have also piled up for the company. But Ola is very, very confident about the penetration of electric two-wheelers in the Indian auto industry. So they say that e-two-wheelers penetration is expected to expand from 5.4% currently to about 41 to 56% by FY28. That's the kind of penetration that they are looking at. If you look at the market share as well, right, Ola is far ahead of its other peers, also considering that it's a pure play EV two-wheeler maker. Ola Electric has a market share of 46.2% as of June 2024 compared to its closest peer, which is TVS Motor at 17.5%, Bajaj at 11.3%, then followed by Ather, which was expected to pick up in a big way but did not, just 7.7% market share, and then Hero MotoCorp at 3.9%. So the big story, of course, is that this listing will take place it's expected around the 9th or 10th of August. The risk factor is that the losses have piled up, but the positive, the larger theme is the huge growth that we're looking at in the Indian electric two-wheeler industry.
I guess there'll be some scarcity premium also associated, right? Because there is
the first time you're getting a pure play EV company,
exactly.
Two-wheelers or four-wheelers, whatever. It's the first pure EV play that you have.
Yes.
So it'll be very interesting to see the market's reaction as well. Thank you very much, Sonia. Very helpful numbers and details over there, putting Ola Electric in perspective. Let's move on. The other big story, of course, happened over the weekend. Yesterday, to be more precise, Ultratech has clinched the deal to acquire India Cements to, of course, cement its position as a key consolidator in the southern region and, of course, just becoming larger and larger in size. The deal will be triggering an open offer for shareholders of India Cement at the deal price. Nisha is here with all of the details. Nisha, so it seems that the Aditya Birla Group's expansion spree continues.
That's right. It's a big competition that they have to counter, which has come in from the new entrants, Adani, a few years back. And therefore, Ultratech's bid to really create and preserve their numero uno position is making Aditya Birla Group quite aggressive on the deal street as well. And of course, given that they have monopolistic situation in a large part of the country, South India is going to be a playground for more consolidation. Talking about this particular transaction, well, after buying out a chunk of stake in India Cements from the investors, Radhakrishna Damani, the writing was on the wall that the acquisition is likely to happen because India Cements had been waiting with a gap of succession there for an acquisition for a long time with many contenders out there. But Aditya Birla Group has clinched this particular transaction by looking at buying out not just the promoter stake, but even the associates put together with over 32% stake for 3,954 crore rupees, which, remember, now puts a total chunk at above the majority controlling position of 55.5%. And this together is coming in at an acquisition cost of roughly 5,800 crore rupees. Add to that the mandatory open offer, which is going to be triggered at 390 rupees per share, and that could take the acquisition cost as per tendering in the open offer above probably 7,000 odd crore rupees, depending on how it's tendered. Now, the deal is likely to be closed along with the open offer and the regulatory approvals required. And here, CCI is unlikely to be any constraint given their position in the southern market, which is not that much. And therefore, it is likely in 6 months' time. Now, India Cements adds the capacity by about 14.45 million tons. Now, Jefferies has an important deal valuation, comment to make. They say that the blended EV per ton deal valuation at $110 per ton is a tad expensive. So that needs to be considered, but that's all for the competitive edge in the cement consolidation. And KM Birla is saying that he has accelerated the target of 200 million tons of capacity by FY27. Now, looking at the current situation, 154 million tons is Ultratech's total total capacity, 200 on track at an accelerated pace. But very important to note here, and my biggest takeaway is that while build versus buy has been Ultratech's strategy, it has taken a clear turn with now acquisitions probably contributing a much larger amount in its capacity expansion in the last few years after the entry of another big conglomerate, and therefore a series of acquisitions have taken place, and India Cements also adds to the might. But it won't stop here, because South India is going to be a playground for Ultratech for more consolidation in future.
Thank you very much for that. And with the potential development in Andhra Pradesh, also investors are looking at South emerging as a big player, as a big market in terms of growing demand in the next 2 to 3 years. Though currently, pricing has been a bit subdued. Nisha, thank you very much for that. On the other side of this short break, we will invite the management of Embassy REIT to discuss their Q1 numbers.
Welcome back. The countdown is on. The next milestone is just about 10 points away. 25,000 in striking distance. What a move for this market, and what a charge on the street by the bulls. Well, while we're looking at that timer and that clock, let's quickly get in one more conversation in. Embassy REIT came out with the Q1 report card as well. The company's revenue growth is about 2.3%. Profit after tax declined due to higher depreciation and finance costs. The occupancy remained at around 85% levels. Let's get in some more perspective. Arvind Maya, CEO of Embassy REIT, is with us. Mr. Maya, thanks for joining in. Let's start by looking at rentals, because I think the rent has gone up, and your DPU growth is also very, very healthy. You're guiding for 7% for the whole year, but looking at the way this quarter has gone, Q1, could you be exceeding your guidance?
Good morning, everyone. So honestly, yeah, I think I want to start by saying that FY25 is a year of growth for us. What I mean by that is, one, of course, our overall portfolio has expanded to 51 million square feet. Our DPU is expected to grow by 7%. Our rentals have grown over the year. So overall, very positive. And quarter one started in line with our expectations. We did about 1.9 million square feet of lease up, and DPU has grown by 4%. Overall, we are sticking to our guidance. We are expected to grow anywhere from 7 to 8%. So that's where we expect to be during the course of the year.
You've also hiked your gross leasing guidance to 5.6 million square feet versus 5.4 million square feet earlier. Can you tell us the reason why?
Yeah, sure. So beginning of the year, we gave a leasing guidance of 5.4. That's gone up to 5.6, largely because of some early renewals during the quarter. But I think just to give a sense of overall market, it's important to say that of the 1.9 million square feet which we did this quarter, it's evenly balanced between pre-leasing, new lease up, as well as renewals. Also, an interesting statistics for this quarter is we did a pre-leasing of 0.9 million square feet, 0.6 committed and 0.3 growth option with one of a large tenant, where we are actually redeveloping one of our existing buildings in Manyata. What I mean by that is, we're breaking down an existing building, which is 0.3 million. We are constructing a new building, which is 0.9 million by utilizing our FSI. So all of this adds to the growth in the coming years.
Okay. In terms of, the outlook going forward, is the change in taxation going to impact you in any way whatsoever, the long-term capital gains tax change that's happened in the budget?
It was very positive for our unit holders. Just taking a step back, it's been about 5 years since we as Embassy REIT did the first REIT listing. At that point in time, we were about 4,000 unit holders. As we speak now, we are about 110,000, which means there's a growing acceptance of REIT as an asset class. And one key aspect which we've been working with various government bodies as an industry is to classify our units as equity or equity-like. So we believe that this, alignment of long-term capital gains to 12 months is a step in the right direction. What we now need is, index inclusion of units in various Indian equity indices that will enable more liquidity in our stock and also increase more of our unit holders.
Arvind, a lot of the business decisions are made keeping 5, 7 years, the long-term picture in mind. We're talking about FY25, but if you could give us the picture for the next 3 years, what are the projections that you have on the various parameters?
Sure. I think when you look at over the next 3 years, right, the portfolio growth comes into play very significantly. What I mean by that is we have close to 9 million square feet under construction as we speak. Why we are very bullish on this is because this is expected to add close to 1,000 crores to our net operating income over the next 4 years. But I want to give 3 important sub-statistics, if I can use that word, on this 9 million. First of all, 100% of this 9 million is being developed in our 2 core markets, which is Bangalore and Chennai. Secondly, 6 million of this is being developed in Embassy Manyata and Embassy Tech Village, which we believe are probably the 2 best assets in India. And lastly, about 5.7 million of this is being delivered in the next 2 years, and 70% of this is already pre-leased. What that means is more or less this growth is kind of confirmed. So this, under construction or organic growth for us is a very important lever over the next 3-4 years, coupled with the fact that we expect a 5% escalation, which is inbuilt into our contract year over year. And lastly, the growth in occupancy. Today, we are at 85% occupancy. We have guided to a 88% occupancy by end of the year. And we believe our target is to go to a pre-COVID occupancy of around 95% over the next couple of years. So a good pipeline of growth in our portfolio over the next 3 to 4 years.
All right, Arvind, a short chat today. Thank you for joining in and giving us some perspective, and good luck with the rest of the year. Well, with that, we will take a break. Look at that ticker. Just about 2-3 points to go. Let's take that break, come back, see where the Nifty is. And of course, we'll have the management of SL Propack also. Epac Durables also with us.
Welcome back. The eye remains on that 25,000 milestone. And not to forget, Asia is also on a very strong footing. Nikkei is up 2.5%. Hang Seng is up 1.8%. But even as we count down, let's invite Epac Durables. They reported their numbers last week. Good set of numbers. Very, very strong. 77% jump in the company's revenues. EBITDA too has seen a 76% increase on a year-on-year basis. Ajay Singhania joins in to talk more about the numbers. Ajay, morning. This is Rima here. Thank you very much for joining in. It's been a very, very strong quarter. And I remember in the last conversation, you spoke about how, last year Q1 was weak. So AC makers were sitting on a lot of inventory, which got cleared out from Q2 to Q4. And Q1 is when you see fresh demand production, manufacturing kicking in. So that's played out. But can you sustain this kind of growth over the subsequent, 3 quarters of this year? What is the visibility that you have? And can you give some numbers in terms of a guidance?
Sure. Thanks, Rima. I mean, definitely this has been an excellent quarter for the industry, and we've grown like 77%. And in terms of sustainability, yes, not only just next 3 quarters, we see a definite good growth in the market for the next 4 to 5 years. Definitely the market is poised. Currently, the brands are sitting on extremely low inventory. So definitely this momentum is going to continue over next 3 to 4 quarters, and beyond that next 3 to 4 years for sure. I don't need to repeat, but the level of penetration we have in the country for air conditions. So, I mean, this is just the beginning of it. We see excellent growth and demand, not only for air conditioners, but also the coming season looks to be very good for the small domestic appliances as well, the other business we are into. So, I mean, overall, yes, all the appliances are set to grow definitely on a good scale numbers this year.
You had forayed into new product categories like air coolers, etc., which you all started in January. Has that contributed, and what would the number be?
Yeah, so this being the first year, definitely we are in a stabilization phase. So we have done pretty good in Q1 because it was the first quarter we did good numbers. And then we are now adding newer customers, newer products for air coolers, as well as we are very excited to announce that our washing machine is on track. And Q3 is when we will see our washing machine in the market. So even on that front, we are very excited that it will give us good numbers, and we will see very good growth even in these the large home appliances we are entering into. So altogether, our strategy of growth, exceeding the market growth for AC, and then the diversification of product portfolio for air coolers, and then washing machines. We are on track to achieve the numbers we have in mind.
Mr. Singhania, do you see any scope to push margins forward? I mean, obviously the top line growth has been very, very robust. You're around 6.5–7% margin. Now, depending on the customers you're dealing with and all the, the product portfolio you're looking at, even beyond ACs, what should we expect on the margin profile, say, over a one-year basis?
See, the overall EBITDA margins we achieved last year was close to 8.12%, and that's the kind of guidance we have, that we continue to maintain that at least 8% is the bare minimum we'll maintain for sure for this year and beyond. And then there is definitely room to expand with the kind of diversification we are looking at. So the product mix definitely will help us further boost our metal margin beyond 8%. But for 1 year, let's say, maintaining at 8% definitely is something we aspire to, because last quarter there were some challenges in commodities which went up, which is going to now settle down, and then the impact is also getting passed on in this quarter and onwards. So there will be recovery on the margin front.
And in terms of product mix, beyond ACs, which are the other products which typically fetch you higher margin where you're trying to grow?
See, the small domestic appliances definitely fetches us comparatively better margins, but then because of the ticket size, the impact obviously does not get reflected substantially in the balance sheet. But now that larger appliances we are getting into, like the coolers and washing machines, especially washing machine, we're entering with the fully automatic, which is a big ticket size product. And then we are looking at expanding the portfolio for the washing machines as well. So we have a complete lineup to begin with the fully automatic, and then semi-automatic, and then even going forward the front load. So that entire lineup, once it's rolled out, we see the margin profile getting changed comparatively better.
Ajay, short conversation today, but we have so many earnings to pour over, and markets too are on a high. So thank you very much for joining in. We'll get into a break. We'll come back with more.
Welcome back. The Nifty is within kissing distance of 25,000, and today you have a charge of the banks that just cannot be ignored. Look at the bank Nifty, 2% higher, and banks across market capitalization and across ownership, PSU, private sector, large cap, mid cap, small cap, everything in financials is just firing away. Of course, ICICI Bank really leading from the front over there with a 3% move after numbers, but SBI, even IndusInd Bank, in which some people can quibble and say that maybe some asset quality issues are showing up. None of that matters. Today is just all out buying. Axis Bank and so many others. Actually, even beyond the large cap banks, the likes of PNB 7%, Bandhan 11%, J&K Bank, Bank of India. It seems like banks are the big trade in town today, Rima.
Well, almost at that 1,000-point rally now for the Nifty Bank, and the Nifty still very, very close to 25,000, but not yet got there. We'll wait by to see how the second half of the trading session pans out. For now, it's a wrap on Trading Hour from the entire team. Thank you for watching.